Hello everyone, this is Atik and today I am going to talk about an activity ratio. But before moving forward, we need to understand what is accounts receivable. When a company sells its product on credit to its customers, the amount due is shown in accounts receivable. So basically, this account shows how much money we are supposed to collect from our customers. Now let's talk about this ratio, that is accounts receivable turnover ratio. This ratio shows how many times a company can convert its accounts receivables into cash over a period of time. So basically, it shows how efficiently a company can collect its account receivable within a period. In some way, it acts as a liquidity ratio because a company is more liquid when it can quickly collect its cash from its customers. Now we will move to the formula of accounts receivable turnover ratio. We get the ratio by dividing the net credit sales by average accounts receivable. We compute net credit sales by deducting sales return and sales allowance from gross credit sales. Usually, net credit sales is shown in the income statement, but not many companies show credit sales and cash sales separately. Now we get average accounts receivable by adding the beginning accounts receivable and ending accounts receivable and then dividing them by 2. Now let us work on an example.
So now we are looking at Mortal Gaming Store, which is a retail store that sells gaming accessories. Due to declining cash sales, Mortal, the CEO, decides to extend credit sales to all his customers. In the fiscal year ended December 31st, 2019, there were $215,000 gross credit sales returns of $10,000 and sales allowance of $5,000. Starting and ending accounts receivable for the year were $10,000 and $15,000 respectively. Mortal wants to know how many times his company collects its average accounts receivable over the year and also the average collection period in days. In step 1, we are going to compute the net credit sales by deducting sales return and sales allowance from gross credit sales. Our gross credit sales for the year were $215,000. From that, we are going to deduct $10,000 and $5,000. So our net credit sales comes to $200,000. In step 2, we are going to compute average accounts receivable, which is by adding beginning accounts receivable with ending accounts receivable and then dividing them by 2. So our beginning accounts receivable were $10,000 and ending was $15,000. If we divide them by 2, we are going to get $12,500. In step 3, we are going to compute the accounts receivable turnover ratio. That is by dividing net credit sales by average accounts receivable. So our net credit sales were $200,000 and we are going to divide that by 12,500. And our accounts receivable turnover ratio comes to 16. Now finally, we are going to compute the average collection period in days. We do that by dividing the number of days in a year by accounts receivable turnover ratio. So the number of days in a year is 365 and we are going to divide that by 16. So our average collection period would come to 22.81 or 22 days. We cannot keep 22.81, that is in decimals, so 22 days.
I hope you found this video helpful. Thank you so much for watching. See you in the next video. Till then, goodbye and take care.